Hi, and welcome to section 4.2 for Econ 2 on the AQA exam board. Today we'll be looking at fiscal policy, the automatic stabiliser, and the effects that fiscal policy has on aggregate supply. But what is fiscal policy? Fiscal policy is the way in which the government adjusts its spending and taxation rates to influence the national economy. The government can use expansionary or contractionary fiscal policies depending on where in the economic cycle the economy is. Expansionary fiscal policy stimulates the economy, and contractionary fiscal policy has the opposite effect, and demand is taken out of the economy. The UK government has a variety of activities that they spend their money on, such as defence, education, and welfare. They also have a wide range of ways in which they can raise revenue through taxation. This can be income tax, which is a tax on income, corporation tax, which is a tax on profits that firms make, VAT, which is a tax on consumption. If a government runs a balanced budget, it means that taxation revenues are exactly the same as government expenditure. However, governments do not always run balanced budgets, and this can be for a variety of different reasons. If the government's budget is not balanced, it adds to or decreases the level of national debt. National debt is a stock, and you can think of the budget as a flow. A budget surplus will decrease the national debt, and a budget deficit will increase the national debt. The national debt is funded by investors buying government bonds. In the UK, these bonds are known as gilts. Gilts have a mature date and a rate of interest that must be paid on the bond. For example, you could have a £1 million bond that matures in 10 years' time that has an interest rate of 2% per year. At the end of 10 years, the £1 million will be given back, and the interest over that 10-year period will be given back as well. The government tends to pay these maturing bonds by issuing new gilts. These new gilts are issued at the market rate, which is dependent on the confidence that investors have in the government's ability to pay the debt back in the future. If investors are worried about the government's ability to pay the borrowed money back in the future, the interest rates that the government will have to pay on these gilts will rise. This makes borrowing for the government more expensive. This is what Greece has experienced since the financial crisis. International investors were worried that Greece would default on the bonds, and investors would therefore never get their money back. Thus, investors have required a higher return on these bonds to represent the increased risk in lending money to the Greece government. Expansionary fiscal policy could be used when the economy is in a downturn. The idea of using expansionary fiscal policy in this situation would be to stimulate the economy and get it moving along again. The government can do this by increasing their expenditure or decreasing taxation. A decrease in taxation would probably cause an increase in consumption and an increase in investment. This is because consumers, if they are workers, will be able to keep a greater proportion of their income, which would increase their disposable income, and consumers would then consume more goods and services. If there was a decrease in corporation tax, firms would then be able to keep a greater proportion of their profit, which would leave more money available to invest. This would probably cause investment to increase. Another fiscal policy would be to increase government expenditure. This could be an increase in the welfare payments it makes, an investment by the government on infrastructure, or increased expenditure on healthcare. An expansionary fiscal policy will shift aggregate demand outwards from AD1 to AD2. There are a few extra points to be made on expansionary fiscal policy. If the government was to decrease taxes, consumers and firms may not change their expenditure plans, as they may choose to save this additional income as they have poor expectations of the future. Consumer and firms' behaviour should be something that the government should consider when they are thinking about using expansionary fiscal policy through a reduction in taxes. If the government decided to use expansionary fiscal policy through an increase in government expenditure, such as investing in infrastructure like a new railway project, then the increase in government expenditure will have a multiplier effect. Therefore, if there was a negative output gap in the economy, the government will not have to plug the whole of this negative output gap because of the multiplier effect. Expansionary fiscal policies are an increase in government expenditure or a decrease in taxation. This can cause the government to run a budget deficit, which would not be sustainable in the long run. We also have contractionary fiscal policies. If the economy is experiencing a boom, then the government may choose to use contractionary fiscal policies. These policies are designed to take demand out of the economy. Contractionary fiscal policies are increases in taxation and decreases in government expenditure, or both of these at the same time. Contractionary fiscal policies can allow a government to run a budget surplus, and they can use this surplus to pay off existing government debt. This brings us on to automatic stabilisers. Over the business cycle, the government's budget will naturally change. During a boom period, employment will be high, which means there'll be a high amount of income tax and a low amount of unemployment benefits going out. Consumption would also be high, which means a high level of VAT, and corporations will be doing well, which means a high level of corporation tax. This results in the government receiving a large income from taxation and spending a small amount on welfare. This means that they are taking demand out of the economy. During these sorts of periods, the government will be probably running a budget surplus. During a recession, the opposite will be true. Unemployment benefits in a recession will be high, and the government will be receiving lower revenues from taxation. These lower taxation revenues come from a decrease in consumption, meaning that VAT revenue falls, a decrease in income tax because fewer people are employed, and corporation tax will probably fall because firms will not be doing as well as they were before. This causes the government to have an expansionary effect on the economy, whereby they increase the level of demand. So the automatic stabiliser states that during a boom, the government will have a contractionary effect, and during a bust or a recession, the government will have an expansionary effect. Fiscal policy can also have an effect on aggregate supply. We will look at the effects that governments can have on aggregate supply in more detail in the supply side section of this course, but it is good to go through some of the effects now. One example of a fiscal policy that can affect aggregate supply is changes in income tax and national insurance, as these change the incentives for individuals to look for work. If there was to be a decrease in income tax and a decrease in national insurance, the incentives to go to work will increase. This increases the supply of labour in the economy, which can cause aggregate demand to shift outwards. Lower taxes may also encourage workers to work harder as their income is higher, so a lower tax rate can increase productivity, which can also cause the long-run aggregate supply curve to shift outwards. Another example of government expenditure on aggregate supply is government expenditure on capital infrastructure. For example, the government can invest in roads or fibre optic broadband, which makes business activity easier. Governments can also give tax breaks for new firms to encourage entrepreneurship and investment, and also tax breaks to encourage research and development. Governments can also spend money on education and training, and this would increase the productivity of employees. As workers are more productive, a greater number of goods and services can be made at a lower price. This leads to a country becoming more competitive, and it increases the productive potential of the economy if workers are more productive.